Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody. Welcome back to Keen on Retirement. I've got two good-looking men staring at me in the face here on the screen.
Goodness.
So, Bill and Matt, how are you?
Well, you're very kind, Steve. I've got my light-colored jacket on today here. I'm holding on to, well, I guess summer, Carissa told me. I think that's a summer jacket, she said. And here we are in middle of October, moving into late October. But, you know, it's been warm here in the Midwest, Steve. So I figured I could get another wear out of this thing. So what do you think?
Yeah.
Looking good, huh?
You're looking good. You got your pocket square in there as well.
Yeah. How about that?
You know what the
solicited-
Farmer's Almanac says about warm Octobers?
Man, it's going to get bad here. Going to get cold, huh?
Cold Februaries.
Februaries. Okay. Now, does this say anything about warm Octobers and what the financial markets do, Matt? Because as data-driven as you are, you probably don't track that, do you?
The weather patterns and the impact on stock trading.
It goes up because everybody's
I'm
happy.
sure there's some
Weather's
analysis there. Yeah. People
For
are out
sure.
spending money.
Oh, for sure.
I mean, it does have an impact on shopping, in person.
Oh, yeah. So, see, he did have an answer for that, Steve. I didn't
That's right.
stump him.
But is correlation causation here?
Yeah. It's probably not enough to make an investment decision on. I
There
would
you
say
go.
that.
It's probably not scientifically significant or statistically significant.
That's
So,
right.
All right. So, Bill, you have 3 grandchildren. Is that right?
I surely do. Yes. I have basically, let's just call it 3, almost 3, 3-year-olds.
Oh, wait a minute.
Girl.
Basically
Oh, no.
3, almost 3.
I'm
Come on.
speaking of ages now. Okay, let me be
Okay.
clear.
Oh, okay. I thought you were thinking numbers here.
Basically 3 years old, almost 3 years
Okay.
old, and then just over a 1-year-old. So the 2 older ones are little girls, and then there's a little boy in there, the 1-year-old, and then I've got one on the way coming up here, just here in a few weeks, the due date.
Yep.
And then another one in January. So,
Nice.
you know, give us a few months here, and I'll be at 5 so far.
Yeah.
So very,
You
very
have
fortunate.
a basketball team.
Very blessed with that. Yes, we could. Yes, we could.
Couple more 529s to fund.
Yeah, that was the thing when I, kind of offhandedly told my first, when the first one was born, I said, hey, consulted with my wife and also my kids and mentioned that I would, help them with college or, get something funded up. And they said, sure. And then they started having more and we had 2 and then the third one came and I thought, my goodness, I don't want to have to cash flow all this a number of years out. So I started opening 529s, Steve. I did.
So does that apply to podcast co-hosts' grandchildren? That you fund their 529s?
Well, you have been on the journey with us for 10 years already.
Right.
So
That's right. It's got to
if
count
you-
for something.
are you going to work that into your next, annual
And
renewal, I guess?
I'll slip that into the contract. How's that?
We don't want to lose you, so I don't want to show my weakness here, but there might be I don't know. Well, it could be
Well,
possible.
he has to keep working if he has to pay for grandchildren's college.
Yes,
That's right.
I do, which means I won't be retired anytime soon, which,
Well,
It's
same
good.
with Steve.
That's right. Yeah.
oh, same with Steve. Good. So
Yeah.
we've got him on the docket
right.
here for a while. So
I'm,
I did a
I'm
Facebook.
little. I just have the two grandkids, so I'm a little behind you. But
Yes. And tell me their ages.
they're both 1.5, so they were
Okay.
born about 6 weeks apart from each other.
Well, how fun. How
Yeah.
fun.
Yeah. So they've met each other now a couple times. So
Yeah.
it'll be fun when they are a little older and a little more cognizant of each other and how they're connected. So yeah, it's been fun to see them together.
Yeah. Yes. Well, we're very fortunate here in that I have all my kids are located in Kansas City. So we talk about this a lot with clients too. Some are spread around the country, and then some of us are fortunate, and it's all good. All the paths are great, but having them all here at this time, it looks as if they may stay here. It kind of put a quash on me thinking I was going to have a second home in Florida or Arizona or somewhere like that, because it really, you get to this point in life, I'll be 57 in December, and you realize, for me, the most precious time, the most priceless time is family time. So that encouraged us to have a place down in the Ozarks, which we've talked about here on the podcast here in Missouri, just a couple 2.5 hour drive. So that is somewhere that they all can drive to, and in some cases impromptu even, and get together. And we do quite often.
Mm-hmm.
So that's something we're very fortunate to be able to have. And so that's how my path has kind of evolved here, and likely will in the future. Steve, I did a Facebook post. You'll get a kick out of this. I did a Facebook post, I don't know, maybe a week and a half ago or so. It really, again, in that same light, right? Posting about a Sunday morning at a restaurant called First Watch here in Kansas City. I think they're around the region and maybe even nationally, but just a really nice breakfast spot, and had all the kids there and grandkids, and for a nice breakfast late Sunday morning. And I did a little post. My daughters took some pictures of me and the 3 grandbabies out in front of First Watch, and I was saying, come on now, get them all look at the camera at the same time. And that was kind of an odyssey to get them all looking at the camera at the same time. So I just took 4 of the pictures where between the 4, they all were looking at the camera, at least not all at the same time ever, but it still was good. And Steve, I got more likes on that Facebook post than anything I post about financial planning. What do you make of that?
Well,
that's my Bill Keene Facebook post. If anybody wants to go look, you could give me some more.
Yeah, that's right.
Likes on the
maybe we should change the topic of the podcast and just talk about loving on your grandchildren.
Mm-hmm.
Well, we certainly could.
It's the algorithm.
It might be more exciting than our topic that we have today about taxes and other things.
Well, I know we've talked in the past about when people retire. Are you retiring from something, or are you retiring to something? And one of the common things that I think you guys hear, that I hear, is, I'm retiring to something. I'm retiring to grandchildren. Mm-hmm. So wanting to spend a lot more time with their grandchildren.
Yeah, that's right. And the appropriate amount of time.
Exactly.
Yeah.
Carissa mentioned me the other day, Matt. You might have seen it come on the calendar just this morning. You're probably not monitoring my calendar that closely, though. But she said, "Hey, we're going to babysit on a certain day here. A few weeks out, maybe a month out or so." And I said, "Well, hey, maybe I can stay home." And I always say that, and then she says, "Well, you say that when you do, you're distracted and on calls and doing Zoom meetings, and I end up having to babysit 4 instead of 3, basically, me included." But I did put it on the calendar, mark the day off. So we're going to see if I can actually be off during a weekday to watch the grandbabies.
Okay.
All right. So, well, if we keep talking about it, this will be the entire episode on grandbabies, Steve. Maybe we should jump into our topics today.
All right. Well, let's jump into the topic of the day, which is we have a handful of listener questions. And the first one that comes in here is from Phil. And Phil says, I've been reading about the new cost of living adjustments that will apply to the 2026 tax brackets. What does that actually mean for my taxes? And will most people really notice a difference in what they owe? So what's going on with the new tax brackets?
Yeah, on a yearly basis, the IRS, they adjust more than 60 tax provisions for inflation. And they do this to prevent what's called bracket creep. And bracket creep occurs when inflation, rather than real income, increases, pushes people into a higher tax bracket. So they're trying to just kind of keep people in the same tax bracket relative to the income. Now, assuming, if you made a lot more income, now, of course, that's going to be, in the appropriate bracket. But if they didn't have these inflation adjustments like automatically built in, Congress would have to decide every single year which we know is usually not good when Congress has to make a decision. And two, we'd have things that wouldn't change for a long time. So people would be in much higher tax brackets. We see this in the provisional income calculation, which is what's used to determine how much of your Social Security counts as income for tax purposes. That hasn't changed since it was implemented in the early 80s. So, what was originally probably designed to not impact that many people impacts that many more people because the numbers haven't changed for 40 years now?
Yeah,
On
that's right.
that.
That's right.
Yeah.
So this to avoid bracket creep. So what we're speaking of today is it's in the taxpayer's best interest, right? Because
It
what
is.
we're saying is that as wages naturally increase, even if it's just cost of living adjustments,
Standard of
the-
living didn't change, but
yes,
you got to raise.
you got to raise. They don't want you that raise, ideally, I guess, to be pushed into a higher bracket. So they raise the tax brackets to offset that, hopefully.
Yeah. And really, when we say they're raising the brackets, what they're raising is the ranges that apply to the current tax brackets.
Great point, because we say that and people might think that they're raising the percentages withheld. So to clarify,
which would actually be an increase. So earlier this year, we had the One Big Beautiful Bill Act that was passed, and that was in July, which made permanent the previous, they were still current at the time, Tax Cuts and Jobs Act, tax brackets that were passed back then. So there's still 7 tax brackets: the 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Now, what is changing with this cost of living increase is how much income is in the 10% bracket, how much income is in the 12% bracket. And, one thing that this kind of slipped through, I didn't hear this discussed very much with the passing of the OBA, I guess is the acronym. They didn't do a good job of putting something together that we can pronounce as well. But the One Big Beautiful Bill Act, it actually changed how the 2 lower brackets, how they're adjusted for inflation versus the rest of the brackets. So the other 5 brackets.
Okay.
So what's happening is the bottom 2 brackets, so the 10% and the 12% bracket, they have a 4% inflation adjustment. And then it's a 2.3% inflation adjustment for the other 5 brackets. So on average, it's 2.7, but...
Right. So why'd they do that? What's the logic behind that?
Well, that would make those brackets larger, so more of your income would be at the 10 or 12% bracket than at those higher brackets. It's not a significant dollar amount, but those brackets are bigger now because of this inflation adjustment.
So it angles to benefit the
lower
income earners, which, and I don't know how much, Matt, you were going to get in today about the new the different tax.
Yeah, I don't think people want to hear me list off a bunch of numbers here because the percentage is what's important.
Yeah, and the new deductions and things for folks that are over 65 and those kind of things that also get
that
phased.
All was part of that. Yep.
And those get phased out when you make over certain amounts of money as well. So it did, I guess, angle toward the lower income folks and this is a very minor difference, but it is a notable difference, like you said, with this 4% compared to, what was it, 2.7? Is that right?
3. So the
Okay.
average is 2.7. Yeah.
So if you're in those higher income brackets, your bracket creep is happening a little bit more than in the lower ones, I guess.
Yep. Yeah.
Okay.
All things being equal. So, that comes out every year in October. So, nothing new. one of the things that they did was changed how that is. So in addition to those two brackets having a different percentage tied to them, back with the passing of the Tax Cuts and Jobs Act, they also changed the inflation adjustment calculation. So they used there's a lot of different CPI calculations, which is it's used by the government, called the Consumer Price Index. And there's different ones for working folks, different ones for retired folks. They have a whole range of calculations that they track. And they were using a certain CPI calculation, for many years. And then in 2017, when they passed the Tax Cuts and Jobs Act, they changed it to what they call a chained cost of living index, or a chained CPI calculation, meaning it's changed or chained or fixed to a certain point in time, which, avoid all the complicated kind of jargon around that. It just means that the percentage increase with these CPI adjustments is going to be lower in the future. So
Okay.
had they used the old formula, the CPI adjustment would have been higher. The bracket creep is now hitting more people based on that kind of change. And that happened in, again, 2017, effective in 2018. So that's been going on for some time now. But yeah, interesting kind of how some of these things, when it plays out over long periods of time, you do start to see some of that impact.
Yeah, no one would know how to
You're
track
not feeling
this,
that,
right? Because
yeah.
it's not something that is being announced like a tax
Here's what it would have
rate
been. Yeah.
change would be so prominent in front of our faces. So
Yep.
there's ways for the government to achieve more income through these other things here. So
Are you saying governments are sneaky?
oh my goodness. I
These
hate to make
bills
that
are,
statement.
they're long for a reason, because there's a lot of stuff.
Well, but we've got
Yes,
AI
that's
now.
right.
We can just upload the bill into AI and we can see exactly what they're trying to pull past us here if we want to.
Well, yeah, you can.
Get most of it right, maybe.
Yeah. So, hey, since we're talking
Yeah.
about taxes, one thing I do want to ask you guys about that I think affects a lot of people is the capital gains tax rates in the brackets. So I'd love for you to just give a very brief discussion of the capital gains tax rates, because there's basically three different brackets here and three different rates. And I'd love for you to just quickly describe how those are applied. And are those also adjusted for inflation every year, those ranges for the brackets?
Yeah. So to answer your last question, yes, they are adjusted for inflation. And up until this year, they pretty much followed the IRS federal tax brackets. However, because they made this adjustment on the two lower brackets versus the other five, they're slightly different now. So there's capital gains. So those apply to gains that you realize. So when you sell something. So there's two types, you have unrealized gains, you own something, haven't sold it, no tax liability, at least from a capital gain standpoint. If you sell it, well, then there's a capital gain or loss, based on what your purchase price was. But if you have a gain, it's taxed. And there's two ways they look at the tax. There's short-term gains. So anything that you held for less than a year, that's taxed at ordinary income rate. So whatever the federal bracket is. If you hold it for over 1 year, so 1 year and 1 day or longer, they have long-term capital gains. And then long-term capital gains, there's a different rate that they apply based on all of your income combined. So if all of your income, and if this is for a married person, if you're single, you pretty much cut it in half. But if all of your income is less than $98,900 for a married filer, or $49,450 for a single filer, there's zero federal tax on capital gains.
Most people don't realize that. This is a planning opportunity that is amazing when we're working with especially retired clients and they've got a pool of money in, let's say, Roth. They've got a pool of money in after-tax capital, and they've got a pool in their IRAs. Yes, they may have some Social Security coming in if they're at those ages and they're taking it, but we can control that income such that they could have some very high capital gains, long-term capital gains that we can
We can
take,
harvesting.
harvest, yes,
Yep.
in the 0% bracket.
Yeah.
To a point, like Matt mentioned.
Yeah, and the way it works from a bracket standpoint is it's additive. Well, for example, let's say you have $50,000 in IRA distributions and Social Security as taxable income, and then you have another $100,000 in capital gains, and you're a married filer. So I just mentioned the threshold's $98,900. Well, what would happen is the first $48,900, that would be zero. And then the additional amount over that would be at 15%. That's the long-term capital gains rate plus whatever your state, tax rate is for capital gains.
Okay. So it's
So
not,
it's not a cliff, but
Yeah.
it counts as income, even though it's not taxed. It just the way the formula works.
So a lot of people would think, I had someone in recently that thought that it was a cliff, that if you went over by
Sure.
$1, that then now it's all 15%. But that's great that you pointed that out. Thank you.
Yeah. And then if your income is even higher, the capital gains bracket moves up to 20%. And again, these are marginal. So it'd be 15 up until this point. It'd be 0 up until the 15 once you hit that. And then once you hit this next trigger, which is $613,000 for a married filer or $545,000 for a single filer or unmarried individual, it moves up to 20% on any amounts over that.
They give the single filer, it's not half, like the 15% bracket is half. The single filer on this 20% is a lot higher than half, because it would have been around 307. So, and these are
sometimes they call that the marriage penalty.
Yes.
Yeah.
And just to clarify, these are, Matt, I think 2026 rates, right? That we're
These are the 26 rates. That's right.
Good.
That's right.
So just to clarify, I want to make sure that I understand what you just said here about it being the incremental part. So let's say someone had zero income for the year, like earned income, but then they had $100,000 of long-term capital gains. And so the bracket is from 0 to 98,900 of income, you pay zero long-term capital gains. And now in this case, since they have 100,000 of long-term capital gains, are you saying that the first 98,900 of that gets taxed at zero, and then the remaining 1,100 gets taxed at 15%? Is that what I hear you saying?
Right.
Okay.
That's right.
Got it.
And if we even wanted to be more, I know we're just talking about kind of these basic numbers, but if we were to say somebody took the standard deduction, if you got the standard deduction, right, Matt, add yet now another 30,000.
That would knock it back down because this is taxable income.
Yeah. So add your standard deduction on there. And then if you're over 65, 6,000 each. If you're under certain thresholds, now you could add in your case,
or
that
itemized deduction if you have that. Yep.
In addition to all the cap gains. So there's some ability to get out of long-term positions. It's still a favorable tax rate, 15% for most folks over their of course, over their ordinary income rate, but still it's something to be very aware of. And you'd be surprised. We sit down with a lot of clients, and a lot of clients, when they're coming to see us, that work with other firms and they're looking to engage with a heavily planning based firm like Keen Wealth, their advisors at the other firms are unfortunately solely focused on the investments, the pie chart of asset allocation, maybe some mutual funds, some things like this. They're not doing this work that's truly the planning based work. And they have had no guidance or instruction on these things. And when you're dealing, we're talking taxes here, and we always like to make the point that, there's a huge difference between tax preparation, and that's when you take your data to your CPA or to your tax preparer, in February, March of the year, and they report history. They're reporting the
That's right.
history of the prior year to the IRS. It's very different than tax planning, where we're looking ahead and saying, what can we do now to affect our taxes in a positive way next year, or actually many years into the future as well, really thinking through a holistic plan. So knowing this type of information is a huge part of that.
Mm-hmm.
Yeah, and just another example here that I think you were talking about, Bill and Matt, here in terms of like planning opportunities. So let's say someone retires at 65 and they're thinking, oh, I need to have some income because I'm retired now and I want to replace my income. And of course, you've all done the retirement income planning, but I'm just sort of giving you an example here. So one strategy could be, we retire at 65. We choose to delay taking our Social Security because every year that we delay it, the payout goes up like 7% ish or so. So you might say, well, we have hundreds of thousands of dollars of long-term capital gains that would be taxable. But in this case, we've got no income at age 65, no income at age 66, no income at age 67. So each of those years, we're going to sell some of the stock that has long-term capital gains in it. And we may be able to cash out several $100,000 of long-term capital gains without paying any capital gains tax on it. Is that possible?
That's right. Yeah, especially at the federal level. State
federal level,
might
yes.
might have a little bit, but
right.
No, that's definitely one of the strategies that we discuss with clients. And in some cases they may not have a lot of long-term capital gains in non-retirement accounts. And in those situations, we might look at Roth conversions in addition to taking out money out of an IRA.
That's right.
Good.
And remember, in your example, Steve, like even if they didn't need the whole 100,000 to live on, we would still probably recommend
harvest the
gains, even if you didn't need the money to live on. Because now you've just been able to lock in that gain.
And you can rebuy the position.
Right. After 30 days, right?
That's right.
Yep. So you don't have the wash sale rule. Great. Yeah. Well, terrific. I'm glad that we talked about that, because I think there's some real planning opportunities for people to think about. And I think that the typical person's not going to be thinking about that. And that's why it takes a professional like you guys to really dig into that and realize, hey, the tax laws do give us some opportunities to do some proactive planning here. So, all right.
Poor Phil asked a simple question, and then we gave him a lot there.
We did.
We gave him way more than he asked for.
Okay. Yep. So send us the check in the mail. We appreciate it.
That's right.
All right. Let's talk. Let's go on to Sue. So Sue has a question here. She asks, I am about to claim Social Security. Should I be worried about not receiving my Social Security with the government shutdown?
Yeah, we've received similar versions of this question in our meetings here since this has been going on. Well, fortunately, there are kind of different components to the budget, I guess, or government spending. They have what they call mandatory spending, and they have discretionary spending. So with the government shutdown, it pretty much freezes discretionary spending, but mandatory spending still continues. So Social Security and Medicare both fall under mandatory expenses. So it doesn't matter whether government's shut down or not because of this budget hasn't been passed yet. Those will still continue. And now there are maybe some less people supporting those programs in the offices. They'll still have some. So that might slow things down from that standpoint. However, online is still going to be available to folks. And, we haven't heard of any issues with anyone getting online, getting it set up, getting it started, with that happening. Now, one of the interesting things that did come about was a delay in the announcement of the Social Security cost of living increase that happens typically in October every year. It was scheduled to be released October 15th. Well, it didn't happen because of the government shutdown. And part of it was because the department that calculates it, the Bureau of Labor Statistics, which is a government department, well, they were part of what was the people that were furloughed. So they've brought them back, and they are releasing that on October 24th. And rough estimate is in that similar 2.5% range. We'll know exactly what it is when they announce it, but that is what it's looking like for your 2026 Social Security payments.
So no effect on anybody receiving money, just the knowledge of what the increase will be was delayed a couple weeks.
That's right.
Basically. Yeah.
Yeah.
Well, except for the government workers
down.
themselves. Yeah. So the government workers themselves are not getting paid except for certain exceptions. And so even the people that have to work, deemed critical and essential, they're working without getting paid at the moment. And then they should get their back pay though, once the shutdown's over. So the BLS, critical. I mean, for financial professionals, because they release a lot of the government statistics. And so the always hotly anticipated monthly jobs report that the government puts out at the beginning of each month, that did not get released in here in the month of October. And so we're sort of flying blind here in terms of what some of the statistics are related to the economy. There's other private sector organizations that put together their own numbers, so it's not like we're totally flying blind here. But it makes it a little bit harder for officials to make decisions when you don't really have the underlying data, or at least not in a timely manner.
That's right.
Good. All right. Another question we have here from Stan, and he says, Medicare open enrollment is happening now, but I am already on Medicare. Is there anything that I need to do?
Yeah, this is great because, when you turn 65 and eligible for Medicare, assuming, you're not working or covered by a spouse's plan, you meet all the criteria to start Medicare, and a lot of folks do. You select a plan that makes sense for you. Hopefully you've researched it and sat down with a professional, or at least, understand all your options. But many times people just don't look at it again. And you do have some choices every year. You don't have to do anything, but should you want to, they have this open enrollment from, I think it's October 7th to December 15th or so, in this range. And if you're on a Medicare Advantage plan, you can change the plan you're on. So that's something that's available to people. If you're on what we call original Medicare, so that's where you have a Medigap policy. So Medicare Advantage, it takes into consideration and covers your health care, and a lot of times your drug plan, kind of all wrapped in one through a PPO type service. So you have a network. And those are very popular plans. Typically, there's no out-of-pocket premium associated with those. That can change from year to year, but that's common for them to have a zero premium or very low premium on a monthly basis because of the way it's structured. Original Medicare, you get 80% of your health insurance covered by your Part B premium, and then you buy a policy, a Medigap policy, for the other 20%, and that will have a monthly cost associated with it. We've typically see those start in the $100 to $200 range, kind of depending on where you live and the provider you choose. So, that's what, if you select original Medicare, you don't have a ton of choices related to that. On an annual basis, you're kind of locked into that plan. You can, if you move, there's some kind of special circumstances that allow you to change plans. But this open enrollment allows you to change the Advantage plan. But the other thing that it does allow is to evaluate your drug coverage.
Yes.
So when you do have original Medicare and you do have a Medigap policy, typically you'll have a drug policy too that's separate than that. And that is important to evaluate on an annual basis because the formularies change, which, that is basically how they classify certain prescriptions and what they're going to cover and how much they're going to cover. So you might have been on on a medication that was a very low cost to you. And then all of a sudden, if you didn't do anything or didn't, evaluate it, you go into the next year and now your out of pocket is significantly higher. And it's because they changed how they're covering that medication.
Yeah, you find out in January when you go to pick up your prescription.
Yeah.
That's it.
And there's nothing you can do now.
Yeah, you're stuck for a year.
You're stuck with that. So it is important to evaluate that. Now, Medicare does have a good website that you can go in there and you can plug in your prescriptions, and it'll tell you the different options available to you. And I suggest everyone do that, at a bare minimum, if if they're on prescriptions and want to understand that. And or at least, talk to a insurance professional that does cover that, because they can also help you with that process.
And we have quite a few consultants here in certainly our region that we trust. We don't get anything back from them, kickbacks or anything. We just ask them that when we send someone their way, that they treat them quickly and competently, which they do.
Yeah.
So, most of our clients, honestly, Steve, most of our clients will go see someone and have them, especially up front when they're first signing up, but then ongoing, like Matt mentioned. And they're able to pretty quickly help folks navigate this kind of thing and make sure they're not missing something. And I did notice, I got some information here that shows open enrollment actually closes December 7th.
December 7th, okay.
Was the date, yes.
Yeah. Yeah. Well, the other thing too, related to the previous question on the government shutdown is, well, how much is Medicare going to cost me next year, or my Part B? And, again, we don't know. That hasn't been announced yet. Now, that doesn't have a set date as Social Security does. We've seen it announced as, late as, sometime in November. So we'll find out when that does get announced. But again, they use statistics from the Bureau of Labor Statistics and the cost of living calculations on what they're looking at. So again, another important piece to our listeners that is impacted by this government shutdown, or at least knowing what it is for next year. Now, I'm sure a lot of listeners would say, well, hey, if they don't calculate it, I'm fine paying the same amount versus it probably going up.
It's not going down, right? I mean, likely.
Well, surprisingly, I've read that the Part D drug plans are slightly decreasing. At least that's the projection.
Okay.
There's fewer carriers, but supposedly that's coming down. So, good thing to know.
Good. All right. Well, those are the questions that I've got here. Anything, Bill or Matt, you guys want to wrap up here for today's show?
I think I love our listener question episodes. I say it, I think, every time we have one of these, because, when we started this program literally 10 years ago, we said we wanted to give folks a look behind the curtain of what we're seeing day to day in our tax and retirement planning, fiduciary firm here. And just so when we're answering questions that our listeners and our clients are asking, we're doing just that. And we're getting to riff on how we would respond to those questions. And whether it's anything having to do with the tax brackets and how those things are calculated, giving people that kind of firepower to understand that, or in this time we're in now, government shutdown talk, Medicare, the health insurance, all these things are super important. And these are the things that our highly credentialed financial planners are talking about regularly, because we're updating our softwares as well. So we're waiting for these numbers to come out, because, we believe that the financial plan is the key. We believe everything starts with first getting truthful about where you stand, So you know what assets you have, what income you have, what liabilities you have, your strengths, your weaknesses. You know the things, you get truthful about where you stand. And we can do that with this comprehensive financial planning process. And then we are able to update our inputs regularly. And the neat thing about it is it's never over. It's a never-ending project. We work with a lot of engineers in our firm and a lot of others too from other industries. But we treat the financial planning process like a project that engineers are managing. It's just a project that has I say never ends. I suppose someday it ends, but it's a long-term project that's constantly being updated and brought back into kind of reality as life changes and the markets change and people's needs and wants and goals change as well. So that financial planning process, I think, is key. And so talking about some of the key inputs on an episode like today helps folks realize just how important that is. And of course, Matt's quarterly market updates where he's talking about the economy and what he's seen coming down the pike. He's done amazingly well on those. He's very data driven. I'd encourage everyone to listen into his quarterly market updates. He's speaking now more toward on those, the engine to the plan. What's driving the plan? You have the plan, and then you have the engine to the plan, which are the actual investments that support the financial plan. Which is why I say the planning is where it all starts. You don't have an engine set off in the corner on blocks, revving up, doing nothing. It's attached to something with a mission, and that mission is what we call the financial planning process. So again, love the episode, and always appreciate both of your input and really driving. I just get to, you make it easy on me. I think I've said that before as well.
Excellent. All right. Well, Bill and Matt, as always, thank you. And for each of you listening, we appreciate you being part of the show here. As always, send us your questions. Just go to keenwealthadvisors.com and drop us a note. We'd be happy to answer any questions that you may have here on the show, or just talk to you individually over the phone or virtually or in the office as well.
For sure.
Please tell all your friends about the show here. You can also watch us on YouTube. So there's a Keen Wealth Advisors YouTube channel. So please make sure that you check that out and that you hit that subscribe button to make sure that you will always get access to it, and the little notification there too. So we can notify you, or YouTube can notify you each time there's a new episode. So we appreciate all that. So again, as always, thanks everybody. And we'll catch you on the next episode of Keen on Retirement.
Right. Thanks, Steve. Thanks, Matt.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.